Want to buy a stock that's priced the same as it was before the pandemic, despite profiting handsomely from it? Does a 4% plus yield and accelerating growth sound good to you? Looking for a great deal on a dividend growth stock after it's dropped by 30%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing the world with various health treatments. Healthcare is one of my favorite areas to invest in. Why? Secular growth. Humans need healthcare by design, and as we age, that need grows. It's part of the human condition. Plus, more people than ever are walking around on this planet, and they are, on average, wealthier than ever. All of that is why this company is poised to continue increasing its revenue, profit, and dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Pfizer Inc., which appear to be trading at a significant discount today. Pfizer Inc., stock ticker PFE, is a multinational pharmaceutical and biotechnology corporation. Founded in 1849, Pfizer is now a $231 billion by market cap healthcare behemoth that employs approximately 83,000 people. The company's fiscal year 2022 sales are broken down into the following three customer groups: primary care 73%, specialty care 14%, and oncology 12%. The US is Pfizer's largest single market and accounts for 42% of sales, while the remainder is international. Pfizer has a roster of blockbuster drugs that includes Ibrance and Eliquis, both doing over $5 billion annually in sales. The company's Prevnar family of vaccines also does over $5 billion per year in sales. And perhaps unsurprising to anyone not living under a rock, Pfizer has had great financial success with its COVID-19 treatments, including the Comirnaty vaccine and the Paxlovid oral medication. These two products have greatly boosted Pfizer's overall sales, and they continue to do so despite the fact that we are more than 3 years removed from the onset of the pandemic. For perspective here, Pfizer is guiding for $21.5 billion in combined sales for these two COVID-19 offerings alone during the upcoming fiscal year 2023. While these massive sales numbers will not persist indefinitely, the temporary bonanza has allowed Pfizer to amass a war chest of cash that can be used for M&A in order to bolster the pipeline. Indeed, the company has already been putting some of that capital to work. Pfizer's $5.4 billion acquisition of Global Blood Therapeutics and its $11.6 billion acquisition of Biohaven Pharmaceutical Holding Co., both completed in 2022, are perfect examples. This is a strong legacy business becoming even stronger. That bodes extremely well for Pfizer's ability to drive its revenue, profit, and dividend higher for years to come. To date, the company has increased its dividend for 13 consecutive years. The 10-year dividend growth rate is 6.2%, which is right about what I'd expect for a mature pharmaceutical business like this. That said, the last few dividend raises have been quite small, in the 3% range. There are reasons for this, which I'll get into, but I also expect this to be a temporary reduction in the growth rate of the dividend. Meantime, the stock offers a market-smashing 4.1% yield. Notably, that's 50 basis points higher than its own 5-year average. And with the payout ratio sitting at 49% based on adjusted EPS guidance at the midpoint for fiscal year 2023, this dividend appears to have no issues whatsoever with sustainability. For income-oriented dividend growth investors, there's a lot to like here. Looking at business growth, Pfizer moved its revenue from $51.6 billion in fiscal year 2013 to $100.3 billion in fiscal year 2022. That's a compound annual growth rate of 7.7%. Strong top-line growth for a mature business like this. However, this has been anything but straightforward. There are a lot of moving parts to account for. Pfizer spun out what became the pets and livestock medicine and vaccinations maker Zoetis Inc., stock ticker ZTS, in 2013. Zoetis is now a $77 billion by market cap company in its own right. Pfizer completed a joint venture with GlaxoSmithKline plc, stock ticker GSK, in August 2019. This JV saw Pfizer merge its former consumer healthcare segment with GlaxoSmithKline's consumer healthcare division. This division was later spun out into what is now an independent business called Haleon plc, which is traded on the London Stock Exchange. Pfizer owns 32% of Haleon, which has a market cap of $30 billion. Also, Pfizer recently spun off and combined Upjohn, its off-patent branded and generic established medicines business, with Mylan NV, creating a new global pharmaceutical company named Viatris Inc., stock ticker VTRS. Viatris is now a $13 billion by market cap company in its own right too. Pfizer has been busy. Looking at profit growth on a per-share basis will clean up some of the messiness, although even this has unusual activity to account for. Earnings per share grew from $3.19 to $5.47 over this period, which is a compound annual growth rate of 6.2%. We can see how this lines up precisely with the 10-year dividend growth rate, showing prudence and care on the part of management even through all of the corporate movements. Recent results can't be discussed without mentioning the massive but temporary impact that Pfizer's COVID-19 offerings have had. We're talking billions of dollars in sales that wouldn't otherwise exist in a world where the pandemic had never occurred. On one hand, had they left things alone, Pfizer might be even better today than it already is. Zoetis, for instance, has been wildly successful. On the other hand, regardless of how one personally feels about the situation, the pandemic was an economic boon for the business as Pfizer stepped in with tailor-made vaccines and medicines and raked in the cash. However, this hasn't necessarily been a boon for the stock. This was a $39 stock in early 2020. It's currently a $40 stock. Those who don't follow the stock market would be forgiven for assuming that Pfizer's stock has just skyrocketed. Indeed, revenue has skyrocketed. The $100 billion sales base is twice what it was heading into early 2020. Despite all the hoopla, though, the stock has round-tripped and is now back to where it started more than 3 years ago. Of course, this surprising disconnect between expectations and reality is why I'm covering the name for the first time in nearly 3 years. Furthermore, it's where the business is going, not where it's been, that matters to those investing today. Looking forward, CFRA is forecasting a 10% compound annual growth rate for Pfizer's earnings per share over the next 3 years. If this projection materializes, it would represent a substantial acceleration in bottom line growth. It's always difficult to forecast a growth rate for a business, but I think it's especially difficult in this case as there are just so many moving parts. CFRA does a pretty good job of summing up the situation from a high level with the following passage, and I quote, "On one hand, Pfizer estimates it has about $17 billion of revenues at risk between 2025 and 2030 due to looming loss of exclusivity. On the other hand, though, we think the pipeline is strong enough to offset these risks and thrive. Pfizer has 19 drugs in development, including 15 developed in-house, with potential for $20 billion in revenues by 2030. That so many of these prospective drugs have been developed internally is a positive sign in our view that Pfizer is not dependent on M&A to replenish its portfolio. On the M&A front, Pfizer still has the ability and the war chest to pursue business development opportunities given the windfall from COVID-19 related sales," unquote. That's basically how I see it. You've got a very decent legacy business that's probably been overly tweaked via unnecessary busyness and portfolio tinkering, and this business fortunately walked right into a pandemic windfall. The pipeline is huge and the company's war chest is being deployed in a way that makes it even bigger. Pfizer has 110 total compounds in its pipeline, with 23 in phase 3. This negates a lot of concern around patent cliffs, such as the 2023 US patent expiration for Ibrance. So how does all this translate over to the dividend? Well, if Pfizer is able to compound its earnings per share at a 10% annual rate over the foreseeable future, that would open the door for similarly sized dividend raises. I believe Pfizer has been conservative with the dividend raises of late because of the Viatris spinoff and the desire to use cash to buy growth. I have no problems with any of that. But with Viatris now in the rearview mirror and with M&A mostly being digested now, Pfizer could be set up to get back to its prior dividend growth ways of 6% or so at the very least. In fact, I'd argue, as CFRA seems to believe, that the Pfizer of 2023 is better than the Pfizer of 2020 was. Now, some near-term caution may still be warranted as overall sales will be falling in the wake of much less demand for COVID-19 offerings, but things should smooth out nicely over the next 24 to 36 months, and if Pfizer is able to increase the dividend at a high single-digit rate, the 4% plus starting yield makes this a compelling total package. Moving over to the balance sheet, Pfizer has a terrific financial position. The long-term debt-to-equity ratio is 0.3, while the interest coverage ratio is over 29. Furthermore, Pfizer has a total cash position that's nearly enough to wipe out all long-term debt. The balance sheet is something that has shown market improvement over the last few years. Profitability is spectacular, although the last 2 years have really juiced the numbers. Over the last 5 years, the firm has average annual net margin of 28.9% and annual return on equity of 26.2%. I suspect that these numbers will come down a bit, but there's a lot of cushion here. Overall, Pfizer is running a great outfit. Sales will fall from unsustainable levels, but the pipeline strengthening should assist the company for years to come. And with patents, IP, inelastic demand for products, R&D, economies of scale, technological know-how, and global relationships, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. I see all three of these risks as elevated in this particular industry. Pfizer is facing concerns around patent losses over the next few years, which puts pressure on the large pipeline to produce more blockbuster drugs. Any large-scale changes to the US healthcare system would almost certainly impact Pfizer. The company's international footprint exposes it to currency, geopolitical, and foreign regulatory risks. Pfizer has recently been very acquisitive, introducing integration risks and questions around capital allocation. Pfizer's size is an advantage, but the law of large numbers may start to come into play and limit growth. I see these risks as pretty standard and quite acceptable for a large pharmaceutical business, and with the stock down nearly 30% from its 52-week high, the valuation appears to be pricing in all of these risks and then some. The price-earnings ratio is 7.3. That's less than half of the stock's 5-year average PE ratio of 15.7. However, this is somewhat misleading as it's capturing a lot of temporary sales and profits. The forward PE ratio of 12 using midpoint guidance for fiscal year 2023 adjusted earnings per share is a fair way to look at the earnings multiple. Still, that's below average and what I think one would reasonably expect to pay for a business of this stature and quality. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6%. This dividend growth rate lines up almost exactly with what Pfizer has demonstrated in terms of its EPS and dividend growth over the last decade. I'm essentially ascribing zero value to the windfall, war chest, pipeline improvement, and growth acceleration forecast to CFRA. It's a huge margin of safety being built in, as I just see so many moving parts and uncertainty here. Moreover, the last few dividend raises have been relatively small. I believe Pfizer could easily blow away this model over the next decade, even if the next 1 or 2 dividend raises are underwhelming. Weighing out the desire to sleep well at night, I'm erring on the side of caution here. The dividend discount model analysis gives me a fair value of $43.46. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates PFE as a 4-star stock with a fair value estimate of $48. CFRA rates PFE as a 4-star buy with a 12-month target price of $52. I came out rather low, perhaps I was too cautious. Averaging the three numbers out gives us a final valuation of $47.82, which would indicate the stock is possibly 16% undervalued. Here's the bottom line, guys. Pfizer Inc. is a world-class firm that comes out of the pandemic looking far better than it went into it. It's wisely using its war chest to bolster its pipeline and set up the business for another generation of growth. With a market-smashing yield, solid dividend growth, a balanced payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 16% undervalued, income-oriented dividend growth investors ought to take a close look at this stock after its stunning fall. And now for a special news announcement. American Express Express Company, stock ticker AXP, just announced a massive buyback program. Its board has approved the repurchase of up to 120 million common shares. To put that in perspective, the outstanding share count is around 750 million. So the buyback is approved to take out as much as 16% of the share flow. That's one of the biggest buyback programs I know of. Warren Buffett owns a huge stake in this company. And if you haven't followed the Oracle of Omaha into this one yet, now might be a good time to consider changing that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.